Hi there, welcome to Kneppy Invest. It is that time of month, the start of the month, where I look at the performance of three portfolios that I am tracking. And to be honest with you, one of these portfolios, the group portfolio, which is a collection of companies that viewers of this channel think will outperform the market over the next 5 years. The group portfolio has been highly volatile over the past 3 months. 2 months ago, the group portfolio was down about 1%. 1 month ago, it was up 20%. Now, at the end of April, it was up only 6%. And I am recording this video 2 hours and 15 minutes after the market has opened on the Monday. And we did expect that the market will be down because what happened on the overseas market on Friday, the NASDAQ was down something like 4.6%. The XGO is down about 1.6 to 1.7% as I speak. And the group portfolio is now only up $1,000. So highly volatile, which is what you should expect in these sort of markets. So we're not in a bull market anymore. The market isn't just going up. So a lot of people think the market just only goes up. There are periods of time through history where the market hasn't gone up for a long period of time. And that could be where we're heading right now. The three portfolios I do track include that group portfolio, which is nothing to do with me. I selected no companies in that portfolio, but I am tracking two of my own personal portfolios based off different strategies. The first portfolio is using my long-term buy and hold strategy that I deployed when I first started investing, because that is the way to invest. We're all told. But over the past 5 years, I have shifted strategies and I'm using more of a short-term sentiment trend strategy. And that has been performing very well, particularly compared to the market and compared to my long-term buy and hold portfolio. Before we have a look at the performance of the portfolios, just want to see how the overall market is doing, looking at the XGO, which is the top 200 companies on the ASX. And the XGO was down 0.8% for the month, which I think quite good. You might think that's a horrible month. But when we compare that to the NASDAQ, which was down 14%, which was the worst month since 2008, I think September, October 2008, the S&P was down 8% as well. So tech stocks are taking absolute hammering. Even those biggest companies like Amazon, even Apple's falling right now as well. We are seeing a lot of weakness in the American markets because they are heavily reliant on technology stocks. We are not. We are actually heavily reliant on financial companies like banks and resources. And those sort of companies actually have been doing fairly well over the past few months. And that's why the XGO is only down 0.8% when some of those overseas markets are down significantly more. So right now, one of the best markets to be in the world is the Australian markets because we are reliant on resources and financials. Before we have a look at the updated group portfolio performance, just want to go back 1 month ago, look at how it was performing at the end of March. And the group portfolio was up about 19.7%, all thanks to Lake Resources, Novonix, and BrainChip. But in a large portfolio, all you need is a few companies to significantly outperform the market, and you or your portfolio will outperform the market as well. And that's exactly what's happened with group portfolio. Three companies have done really well, and the rest of the companies have not done nearly as well as those three companies. In fact, when you look at the worst performers 1 month ago, which was Zip, Kogan, Alcidion, Pointerra, Credit, they were all down. But because the maximum you can be down on those losing stocks is 100%, or about $4,000, it's significantly lower than the upside to those winning companies like Lake Resources, a return there of $23,600 at this point in time. So this shows you why sort of the long-term buy and hold strategy can work, because you pick up the upside, significant upside of these companies whose share price go through the roof, like Lake Resources, and you have significantly more upside than the downside of those companies that don't perform. And that's why people like Peter Lynch say only 6% of the companies he invested in actually succeeded in the long term. It's just that he held on to those companies for a long period of time. And that's why we get taught and told the only way to invest is to buy companies you think will outperform the market over the long term. But it's not the only way to invest. I think this sort of investing strategy only suits those with the personality to do that. There are other types of personality out there that I think this type of investing strategy doesn't suit. And I think possibly I'm one of those people. Now, as we head into April and the end of April, the group portfolio, instead of being up almost $20,000, was only up 6.5 because this was a weak month, particularly for tech companies. And it seems like the group portfolio is more highly correlated to the NASDAQ, S&P 500 than the Australian markets, even though we do have some resources companies here in here, like Fortescue, also BHP. We also have Woolworths and CSL, BlueScope, Soul Pattinson. So you'd think a lot of those companies really won't be significantly down in any period where we do see significant weakness in the market. In fact, some of those companies aren't the best performing companies in the group portfolio because they are still Lake Resources, Novonix, and BrainChip, but they still are either up by a little bit or down by a little bit. The worst performing companies, down by over $2,000, has grown from 3 to 7, and that includes Credit Intelligence, Point Terra, Megaport, Email Payments, because they have a significant, I think it was a profit downgrade. Megaport had a significantly bad Appendix 4C, so their share price is down a lot. Alcidion, Zip, and Kogan at this point in time, based off total maximum losses, is the worst performing company in this group portfolio. They also had a trading update, and the market did not like that trading update at all. Now, most of the stuff in here is straight from Share Site, and I just like this slide here because you see how the group portfolio, or any of the portfolios I show you in this video, track against the overall market. So the group portfolio is in the orange, and the S&P 500, or SWD, which is the ASX 200, is in the red or very dark orange. And throughout this period, for the majority of this period, the group portfolio has outperformed the STW, except for a very short period of time a few months ago. And right now, the group portfolio is tracking almost identically to the STW. So the group portfolio is up 6.53%. The STW is up 6.35%. The majority of the gains in the STW have been through dividends, 4.5% of dividends, only 1.8% capital gain, which is sort of the reverse of the group portfolio. Capital gain there is 4.8%, while dividends is 1.7%. So you can just see over the past 3 months, there's been a lot of volatility in the group portfolio. Up big, down big, and down big again. Now, before the start of this calendar year, the tracking, or the group portfolio, was tracking significantly higher returns than the STW, but there was a lot less fear in the markets back then. And that fear has increased, and that's why we're starting to see a lot of volatility. I think a lot of the market, a lot of participants in the market aren't quite sure what's going to happen over the next few years. They are a bit scared of inflation. Now, I am ignoring what's happening in Ukraine. I think that's it won't have a major impact on most companies on the ASX. But if that does continue, we might see continued supply chain issues, particularly if China remains in a lockdown for a long period of time. So that supply chain issues might keep inflation elevated for a period of time. That's actually not good news, because no one's really getting a wage rise or wage increase, or majority of people aren't getting a wage increase in Australia right now. So their real wages are going down with higher inflation. I know I'm not getting a wage increase. If I do get a wage increase, it'll be like 1 or 2%. And at this point in time, my real wages are going down. And if the majority of Australians feel their real wages are going down, they are going to spend less. And that's why I think there is a little bit of fear in the market. They are concerned about the possibility that economies in the world might be heading towards a recession. Now, onto my own personal portfolios. And to be fair with you, this is my long-term buy and hold, and it has not been performing as well as I would like, and I just think this is not the right strategy for me. And the reason I'm thinking that is this is supposed to be more passive than active. I'm supposed to be holding these companies for the long term. But when I look at the best performing companies in this portfolio, 6 of the best 7 performing companies have been those companies I've sold out to take profits, which has included Beam Communications, Revisum, Alexium, Ambertech, and Australian Clinical Labs, and Aussie Broadband. I took profits when the share price of that company went up. The only performing company, or best performing company that I still hold in the portfolio, is BrainChip. So maybe being a little bit more active over the past or since the start of the calendar year would have meant that the performance of this portfolio would have been better than it has been. And a lot of the companies that are in this portfolio right now are underperforming. So the question is, should I remain patient and hope, and that's the word here, hope that these companies' share price will turn around? It does look like some of them are turning around, but at this point in time, still a lot of the companies in this portfolio are down quite a bit, just like the group portfolio. And I don't have significant winners, unlike the group portfolio. Now, to be fair to myself, this long-term strategy has been performing or has been exceeding the performance of the STW until the last 2 or 3 months when we've seen significant weakness on the overseas market. So just like the group portfolio, I think a lot of the companies in my portfolio are more correlated to the NASDAQ, those sort of markets, than the Australian markets, because I don't have any resources in my long-term buy and hold portfolio. I think those are just short-term or medium-term holds. I don't have any banks as well, or many financial companies in that portfolio. So overall, my long-term portfolio is only up 0.76% compared to the overall market, which is up 6.35%. It's only been the last 2 months where the long-term portfolio has underperformed the overall market. Now, onto my second portfolio, using a strategy where I look at the sentiment and the trend of the company's share price, and I take positions based off that. If I see a shift in sentiment or a shift in trend, that's when I might take a position. Or if I see a bit of a dip in the share price, when the share price has been in a long-term uptrend, and that's exactly what happened with Johns Lynd Group. Share price is in an uptrend. I saw a little bit of dip, and I took advantage of that dip. South 32, I bought that 2 years ago, almost 2 years ago. And because I've held on to that company for 2 years, I think the title of this portfolio might be a little bit wrong, because it's not really short term. I don't think 2 years is short term. So we're heading towards medium to long term. But the thing with South 32, share price just keeps on increasing. So I have no reason to sell that company, because you just want to ride your winners as long as possible. So that's what I've been doing with the best performing companies in this: Johns Lynd Group, South 32, OFX Group. And the reason I bought into that company was there was a shift in sentiment, a shift in trend, and I took advantage of that. And over the past 3 months, I've started to hear a lot more fund managers become interested in that company. So it seems like the market was a little bit ahead of the fund managers, and I have seen that a lot happening over the past 3 or 4 years. Fourth best performing company was Capricorn Metals, and the fifth was DGL Group. I have taken profits in AGL Group. So even though the share price is still an uptrend, I don't think that's a highest quality company. So I've decided to take profits with AGL Group after the end of this month. So that will be portrayed in the next month. Now, I was a little bit more active towards the start of the month in April. I did dispose of one company, but I also bought 2 companies. And I also have $4,900 of cash. Now, the cash levels in this portfolio will either go up or down depending on the overall sentiment in these companies, which is determined or could be determined by the overall market. If there is a sort of a disconnect between the trends in these companies and the overall market, I could be holding on to a lot of these companies for the longer term. And these other companies I sold and bought during the month. I sold Revison because sentiment had shifted to be more negative. I have that company in my long-term portfolio outside the portfolio I showed you, I think. Anyway, the reason I sold that was sentiment has shifted to be more negative. Didn't take profits because it was down a little bit from when I bought in, but I don't care about that. It's all based, my sell and buy decisions all based off sentiment. And if I see sentiment shifting from being positive to negative, or trend of the share price going from positive to negative, I don't care if I sell out of a company at a small loss. Hillgrove Resources, I bought that company towards the start of the month because the trend had shifted and the share price of that company has increased by over 10% since I bought, and right now was at about 7.8 cents. And Costa Group, a lot of positive things to say about Costa Group, in particular the sector they're in. A lot of tailwinds, a lot of positive momentum in that area. So Costa Group, I took a position in that company on the 14th of April at $3.36. I think the share price now is at $3.34. So really, share price has gone sideways. My ultimate aim for this portfolio is to double the market returns. So with the STW up 6.35%, I would prefer the short term, maybe I should call it medium to long term strategy or portfolio, is only up 11.46%. So not quite double the market returns, but I did neglect this strategy for about 4 months, from the start of the financial year to about November. And as soon as I started paying attention, started to be a little bit more active, that's when we started to see significant gains in this portfolio. So I really think this strategy suits my personality. I really like buying and selling, researching companies that I might buy and sell, looking at charts, that sort of thing. So I think this strategy suits my personality. So I am thinking that eventually I'll head towards using a strategy which is not solely based off sentiment and trend, but also includes a bit of fundamental as well. So I think that's the right strategy for me. And that's the key to investing, is finding the strategy that suits your personality. There are many investing strategies out there. There's not just one, and you'll get told by a lot of experts that there is only one way to invest. There's not. And here is the overall performance of the 3 portfolios versus the STW. And at this point in time, the short-term sentiment and trend strategy is significantly outperforming the overall market. The group portfolio is slightly outperforming by 0.1%. 1 month ago, it was almost tripling the market returns, while my long-term buy and hold strategy is significantly underperforming the market. So that's another reason why I think eventually I'll stop buying into companies for the long term. That buy and hold strategy doesn't seem to be working for me right now. And maybe one of the reasons it's not really working for me is I'm putting most of my time into the short-term sentiment and trend. And I think possibly I should be just focusing on one strategy. That's the thing I might be learning right now, is focus on the one strategy, focus on that strategy that works for you. That's all I have for this 10-month performance update for the 3 portfolios I am tracking. Can't believe it's been 10 months. So we're almost at the 1-year anniversary. Not sure what I'm going to do with the 1-year anniversary, but the whole point of me doing this video or this exercise is to see if we could outperform the market over a 5-year period. So we're 20% into that 5-year period. So 4 years to go. Well, 4 years and 2 months to go. If you have any questions, if you think I should start just using one strategy, using 2 strategies at this point in time is not working, because I tend to ignore the strategy that is not in favor with me at that point in time. And right now, the long-term buy and hold strategy, I'm really not paying attention to that portfolio. So I'm thinking of wiping that strategy clean, wiping that portfolio clean, particularly of those companies that are in a downtrend when it comes to their share price. So if you have any questions, just leave it in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.